Welcome to Yahoo Finance Live. I'm Shauna Smith along with Alexandra Canal. Let's get you up to speed. We've got 60 minutes to go until the close of the trading day as we start this holiday shortened week. And you're looking at a bit of a mixed picture here. The Dow and the S&P both trading to the downside below the flat line. The Dow off just about 88 points, so off its lows of the session. The S&P off just about 0.1%, but the Nasdaq holding on to gains up just about 0.2%. When you take a look inside some of the sector action here, that's really telling the story of what's happening in the markets today. Energy, the XLE, the outperformer amongst the S&P sectors here. And that comes as we see this pop in crude prices hitting the highest level that we've seen of the year, the highest level that we've seen actually going back to November, on the news that Saudi Arabia is planning to extend its production cuts. So we're seeing crude prices closer to $90 a barrel, XLE being among the outperformers there. On the flip side, though, we're seeing some pressure in utilities, materials, and industrials, those three sectors lagging today's action.
Well, investors are eyeing a return of the IPO market thanks to companies like Instacart and ARM Holdings. The chip giant is looking for a $52 billion valuation when it goes public later this month, making it the largest IPO of the year. Joining us now is David Wagner, Aptus Capital Advisors portfolio manager. David, thanks so much for joining us. When we think about ARM, what does this signal about the return to capital markets, especially after the IPO drought that we've seen the past year and a half or so?
No, thanks for having me back on, Alexandra. I really do think it means a lot. I mean, this IPO is one of the largest that we've seen in quite some time. Though I think there's probably a little more negative asymmetry risk to the IPO market coming off of ARM, because I don't think that it's going to live up to all the hype. I mean, right now you're going to have to pay basically an arm and a leg for valuation coming in here. I mean, the thing's going to be trading at 89 times forward earning, 26 times sale. And to make that a comparison, it's probably closest competitors are going to be Cadence and Synopsys, but I think everyone's going to, pigeonhole NVIDIA as probably the closest competitor. And they trade about 22 times sales and about 32 times earnings. So much less than ARM. But at least for NVIDIA, you actually have a long runway for growth with the AI chips through GPUs. But if you look at ARM itself, for what they're providing, I think what they're providing to their end markets, which tend to be more on the Internet of Things. So think the phones and just different laptops. It tends to be the end part of their business cycle. And that's why they're shipping off more towards a subscription-based provider structure from a business model standpoint. So you're paying a lot of money for this stock, yet you're getting substantially less growth relative to a lot of peers. So I think once push comes to shove, I don't think there's going to be as much hype around this IPO as what was originally expected a few months ago.
So David, you got some questions there, it sounds like, about the valuation, but what does it tell us more broadly just about the IPO environment right now? If we do see a successful initial public offering here from ARM, are we going to see a little bit more activity before the end of the year when it comes to publicly traded companies?
Yeah, I would say that there's going to be a positive correlation instead of an inverse correlation. But that's why I think that, I don't have a full believership in the IPO market going forward, because I think there's going to be a lot of negative sentiment coming off of the ARM and possible Instacart IPO itself. Or a lot of companies just aren't going to want to go public in this type of environment right now.
And related to that, if we do see an uptick in IPOs down the line, what does that say about M&A? Could we see more M&A down the line as well?
I think we're going to be seeing more of that right now. But I think, there's still a lot of capital out there. I mean, just look what SoftBank sold part of their ARM holdings for, or actually paid for not too long ago. They're paying $64 billion. Now, I'm not saying that, SoftBank tends to be the value buyer out there in the market, because it does seem, anecdotally that they tend to overspend for stuff. But it's showing me that there's still a lot of excess capital, a lot of excess liquidity out there for companies trying to put capital to work, whether it's on the IPO side or at least on the M&A side right now. Because, what a lot of these companies have, especially on the tech and the growth side, what you've seen this year relative to last year is their valuations substantially expand. And when push comes to shove in the M&A market, your valuation, your PE, your price to sales, if you issue equity, in a way, that's some type of currency out there that they're getting more bang for their buck than where they were maybe a year ago.
Well, a big driver, no question, has been the Fed and Fed policy here over the last several months. Today, we heard from Fed Governor Christopher Waller signaling that a pause in rate hikes is likely this month, saying that the recent string of recent data is buying the Fed more time. Do you agree with that sentiment? And I think more broadly speaking, do you think the Fed has actually hiked enough and they should be completely done at this point?
What's another 25 basis points after they've raised 500 or so basis points since March of 2022? I'm actually a firm believer in the Fed right now, at least what the dot plots are saying. I do think that rates are going to have to remain much higher for much longer, especially relative to market expectations. I mean, just think of, the deterioration in the S&P 500 back in, early August. A lot of that was due to the fact that, the expectations for the investors or the market itself thought that, rates originally they thought we're going to get your first cut in March of next year. That got moved on until May itself. So what I'm really seeing as a big risk to this market right now, especially as, you saw the market rally at the end of the month, was the reintroduction of the right tail risk of interest rates to that market. It's basically me saying that exact same thing. Is the market, our market participants, finally going to put merit and belief to a lot of what these Fed governors are saying that rates are going to be higher for longer? Because on average, rates, once they hit their peak rate, they tend to stay there on average, historically speaking, by Fed standards for about 7 months. And yet we're still expecting one rate hike in November right now. So that would say to me, at least, that you're not going to get some type of rate cut until the middle of next year if history provides any type of information.
Another risk to this market is a possibility of a recession. Just earlier today, Goldman Sachs lowered its probability of a U.S. recession in the next year to 15%, down from the prior 20%. Are you as confident that we won't see a recession within that time frame?
I have to put some type of merit behind what Goldman Sachs says, because they've been more correct than a lot of other people out there in the market, to be fully honest. And if you look at capitulation, if you look at, like the Bank of America, A2 standards, a lot of reports saying that we're not, at max bullishness right now. So I still think that there's still some room to run for stocks right now on the belief of many, of the bears turning more into optimistics heading in towards the end of the year. Because, it feels like every single morning when I look at my email that we're seeing other sell-side shops increase their estimates for 2023 earnings per share, while also leaving expectations for 2024 the same, which is calling for about 11% growth, which is higher than, what history says. History says EPS growth year over year on average is like 6%. So you're almost 2x that right now. So if you believe a lot of those estimates right now, you're definitely going to reside in the camp that, the Fed is really going to pull off some type of soft landing.
Well, here we are. We have the S&P holding above 4,500. When you talk about those investment opportunities or maybe what might drive the market to the upside, what do you like?
I'm probably a contrarian on this right now because it's definitely a trade that has not worked year to date. We know that this market, 75% of the S&P 500 return has come from the Magnificent Seven, which has really driven, the S&P 500 up 18% this year. And 93% of that 18% increase has come from valuation expansion. I'm going to be betting on more of the average stock moving forward, whether it's through RSP ownership or what I would consider to be my favorite asset class right now is to be small cap value. Small cap value or small cap in general tends to trade at a 4% premium to large caps. Yet right now it's actually trading at a 30% discount. So right now the market's saying, hey, this earnings degradation that we're expecting in large caps, well, we're already pricing it on the small cap side. So right now you're getting good or higher than growth in small caps and large caps. You're getting a much lower valuation. Then if you look at a lot of the qualitative aspects for small over large, you're getting a lot of reinsuring going on in the United States, which is going to benefit small caps. You're getting, I think, a huge CapEx spending cycle that has been very much underdeveloped for basically the last decade and a half, which is going to benefit small caps. And if you're a persistent believer that inflation is going to be structural and stick around for longer, well, small cap value is actually the best asset class to own because it is the only asset class, small cap value, to outperform inflation every single decade dating back to the 1930s.
David, you mentioned the Magnificent Seven. Apple is part of that grouping. We're seeing shares up more than 45% year to date. They have their big event coming up later this month. Do you expect that to be a catalyst to not only the stock, but maybe the broader markets as well?
Well, it tends to be a catalyst for suboptimal returns moving forward. I mean, if you just look at the seasonality of Apple and how it trades into their historic, September events, it tends to do quite well in the 3 to 6 months heading into that event. But after that event, towards the end of the year, the stock actually tends to perform, quite paltry. But I think you're getting kind of a different wild card picture because we obviously know that the iPhone 15 is going to be coming out, with 4 different models. You got to be focusing on pricing of these models. You got to be focusing on the shipments of these models. But what I think that the market's kind of underappreciating right now that not many people are focusing on was actually the event last week with Hawaii. Hawaii came out. It's called their Mate 60 phone. And what we know is that if you look historically speaking, the market share of the Hawaii phones tends to be about 15%. with Apple being about 7% in Asia. Due to a lot of the sanctions from the US on China back in 2019, you saw a precipitous drop in that market share for Hawaii. So if you look at China itself, their preferred provider is going to be the Hawaii phone, not the Apple phone. And basically for every 1 million iPhone units not sold that have been taken over by Hawaii, that's like a 1 cent earnings per share hit to Apple's bottom line right now. So I think that's one thing that a lot of people aren't focusing on right now for stock trading at 30 times.
Well, I'll have to see. All eyes will be on that event. David Wagner, thanks so much.
Thanks.
Oil prices spiking today, hitting a 10-month high as Saudi Arabia extends its production cuts. And Esfere is here with a closer look at those details. And we're not too far from $90 a barrel.
Yeah, that's right. And Brent crude certainly hit $90 a barrel. As far as WTI, West Texas Intermediate, that closed at $86.89, 69 cents a barrel. But look, this move that Saudi Arabia just announced to extend those production cuts, this will hold the output levels at the lowest in several years, with Saudi Arabia doing this unilateral, I should add, production cut, one that it had announced earlier this year. This is on top of the OPEC Plus cuts. It's also on top of the Russia cuts as well, because Russia had announced that it will be cutting some exports as well. But it's also a very clear message from Saudi Arabia, basically saying that they want to keep a floor on prices or prices elevated. And as one analyst put it, they are putting a strategy of price over volume. And I spoke to also another analyst that was telling me that as long as Saudi Arabia is able to sort of keep OPEC Plus members in line with this strategy of cutting production, then you will continue to see these elevated prices, because there isn't really a catalyst to bring down these prices unless it is a global recession. If we start to see a recession globally, then you will start to see prices falling. But for the meantime, look, WTI and Brent crude both, since the lows in June, are up 25% from those June lows. Not a good sign for inflation.
Not a good sign for inflation, and of course not a good sign off of that for Americans who are likely going to be paying even more at the pump potentially here over the next couple of weeks. All right, Ines, thanks.
Thank you.
Let's check in on some of today's top trending tickers. First up, we got to take a look at United. Shares off just about 3%. Now the airline moving lower after it issued a brief ground stop nationwide. According to the FAA, the airline experienced technology issues and was unable to dispatch flights through their normal procedure. So we're looking at United under pressure here. Ali, this is nothing new when it comes to the airline industry, right? We all remember what happened to Southwest back around the holiday season when they were forced to ground flights. They weren't able to get those flights off of the ground because of some of their own tech issues here. But it speaks to one, outdated systems that these airlines are working on. But that's also not the only story that's going on with airlines today. We were just talking about the jump that we've seen in crude prices. Clearly, that is also a headwind, a challenge here for the sector going forward.
Yeah, it feels like airlines can't really catch a break. You also have worker shortages that include the pilot shortage. You mentioned that Southwest meltdown back in December. Clearly, that was scarring to a lot of consumers. And it made me think about how when anything goes wrong in an airline, you see it online, you see it on social media, people have their phones out, and it adds to this pessimistic outlook when we think about the future of travel. That being said, consumers are still traveling. It makes me wonder what could happen for the holiday season and whether or not these airlines are able to handle that demand, both on the tech side, on the worker side, and then, as you were mentioning, with fuel prices as well. So a lot of questions there, but you're seeing the sector down across the board right now. But speaking of travel, let's check in on some of the EV makers. Tesla shares riding higher today after data from the Chinese Passenger Car Association showed that Tesla sold over 84,000 EVs throughout China in August. That marks a 9.3% increase from a year ago. Sales of Tesla's China-made Model 3 and Model Y cars rose over 30% from a month earlier. So, this is good news for Tesla, especially considering how much competition is in China that's leading to the pricing wars that we're seeing across the sector. Last week, we saw Tesla once again cut their prices for its Model S and Model X in both the US and China. We'll see how that impacts demand and margins moving forward. But so far, it seems to be so good.
Yeah, and I think the sentiment here, at least more broadly speaking from the street, has been that they're willing to sacrifice some of the pressure that we're seeing on margins, at least in the short term, in order to kind of gain that sale picture, expand the market base, or really, I guess, in this instance, defend their market share, because we know that's such a critical issue here for Tesla, not only in China, but also obviously what's going on here in the U.S. But when you take a look at these sales numbers across the board that we've seen over the last couple of days, Li Auto, a huge competitor to Tesla, the domestic competitor there in China, they delivered nearly 35,000 cars in August, up 663% from a year ago. So that massive jump just really speaks to the fact that Tesla under even more pressure from some of these domestic players. And as they continue to increase their deliveries, as we've seen over the last several months, obviously Tesla needs to do something in order to boost future sales. And they've turned to price cuts. So we'll see whether or not any more are on tap, because I think they've already changed the price of some of their models 6 or 7 times.
7 times.
Since the start of
crazy.
the year in China and in the U.S. too. All right, well, shares of Airbnb and Blackstone both higher after it was announced that the two companies are going to be joining the S&P 500 as of the opening on September 18th. They will be replacing Lincoln National and also Newell Brands. Obviously, some excitement around this announcement. You're looking at gains of just about 4% for Blackstone, nearly 8% for Airbnb, and Airbnb having its best day that we've seen in quite some time. I was going through some of the analyst reaction here, at least when it comes to Blackstone. Morgan Stanley calling this a major milestone for Blackstone. Evercore calling it a game changer for the company and a clear positive, not only for Blackstone, but also specifically for the alternative investment asset management industry. And I think you can make the same case for Airbnb as well.
Yeah, it just creates more buying opportunity, which is why we're seeing this upward trend in the share price. But when we think about Airbnb, we were just talking about the airlines and travel and how a lot of consumers are spending their discretionary income on experiences. Airbnb has certainly been a benefactor of that. Year to date, the stock has surged more than 65% on that travel demand, with CEO Brian Chesky saying on the last earnings call that guest demand remains strong and that nights and experience booked increased 11% in the second quarter compared to a year ago, while active bookers grew in every region. I'm a big fan of Airbnb. I just booked one for a trip I have coming up, and it's one of the most reliable services, especially when hotel prices are very expensive right now.
I was going to say also a lot of times, and now it obviously depends what you're renting, but a lot of times it offers a cheaper option than when you stay at hotels. So clearly in this type of environment, people still want to travel. We talk about the pent-up demand, but they're being a little bit smarter about their budget. So a name like Airbnb benefiting there within the space, at least for now. All right, let's do a check of the market sponsored by Tasty Trade. We've got just about 40 minutes to go in the trading day. Now you're looking at losses across the board. The Nasdaq just below the flat line. The S&P holding just above 4,500. The Dow off just about 140 points.
Well, we're just getting started here on Yahoo Finance Live. Coming up, a new wave of legal battles set to impact some of the tech sector's giants. We break down the Digital Markets Act on the other side. Plus, we head out to the 2023 Goldman Sachs Communacopia and Technology Conference as Brian Sazzi catches up with the CFO of Zoom to discuss the impact of AI in the workplace. And in the 4 p.m. hour, we check in on the state of the buy now, pay later industry with the CEO of Klarna. All that and more when Yahoo Finance returns. Homebuilders among the hardest hit stocks on Wall Street this afternoon. Yahoo Finance's Jared Blickery is here with a closer look. Jared, what are you seeing?
Well, I'm seeing a lot of red today, and this is a marked contrast from what we've seen through most of the year. And I'm going to show you some different time frames here, but you can see all of these stocks here down about 5% or more. Now, you take a look over what's happened over the last month. You can still see mainly red there, but let's just take a look at the year to date, because this has been an outsized performer in a year where we have quite a few outsized performers. You would think these are mega caps, but these are clearly not. We have Dr. Horton there, that's up 28.5%. Lennar just behind it. Toll Brothers almost twice that at 60%. Beazer Homes 116%, and the big leader here, Hovnanian Enterprises, that is up. Let's see, on a year-to-date basis, that is up. There we go, 185%. And you can see it's really accelerated as of late. Now, what are the factors at play here? I'm seeing interest rates being blamed for this latest move down, and that would be blaming today's price action here. We do have the 10-year T-note yield rising, but it's not as simple as that. I went and I plotted XHB, that is the S&P Homebuilders ETF. That's this red line right here. This goes back to late 2018, so covers all the pandemic and a little more. And then in blue, I have the 30-year Treasury yield, and that is in that light purple here. And you can see XHB, the Homebuilders, they were able to advance from, let's say, the beginning of 2020 through most of 2022. Meanwhile, the 30-year Treasury yield was going up. Here it was going down. Here it's going up again. So not necessarily a big direct correlation there. However, I will say when the yield gets pretty high here and it starts getting a lot of focus, those 7% into those 7% mortgage rates in the news, when we had this top here, this local peak in late last year in the Treasury yield here, we did see stocks kind of take off after that. That was mid-October, and that was actually a low in stock. So although you would think there's some kind of inverse relationship here, there's a lot more at play when you're looking at the homes market. It's not just new homes that are being built, but also the existing ones. Is the data coming out stronger than expected, weaker than expected? It's not the absolute level of interest rate. It's also the relative and also the slope of the yield curve. So having said that, we have a little bit of a down action here today. Maybe it's a bellwether of things to come in the coming months, but certainly not reflective of the strength that we've had this year. Now, I want to totally switch gears and go to another industry group that has seen tremendous spurts of growth over the last few days. In fact, on a 5-day basis, the cannabis sector is up, well, 62% there. We see 32% for Tilray, CGC 75%. All of this is on the back of that scheduling, that rescheduling by the DEA of marijuana. We're going to have to see if that takes effect, but nevertheless, some huge positive price action for the cannabis industry there.
All right, Jared, thank you so much. I know you'll be continuing to track all of these stock moves.
Thank you.
Again.
Well, Disney's dispute with Charter-owned Spectrum is showing no sign of letting up. The media giant urging customers to check out its Hulu Plus live streaming service. Meanwhile, Warner Brothers Discovery warning that the ongoing Hollywood strikes could cost the company up to $500 million. Here with more, I want to bring in Michael Hirschhorn. He is president and CEO of Ish Entertainment, along with Kevin Tran, Morning Consult media and entertainment analyst. Great to have both of you. Michael, let me start with you, and we'll start with the Disney Charter dispute. What does this tell us from your perspective, a former TV executive? What it tells us just about the changing media landscape and what we could see for future distribution contracts?
Well, I think this is really symptom more than cause of, what I would say is an ongoing secular decline in cable television. When I was running a network in 2008, it was netting billions and billions of dollars a year at huge margins. The spend in cable was through the roof. All of that's kind of gone now. There's a reason many of you watching have cut your cords, don't have cable subscriptions, or if you still do have cable subscriptions like I do, you're really rarely using them. I'm finding most of my consumption is happening over streaming. I'll watch sports on cable if I have to, but other than that, there's just limited interest in cable programming, and the studios have largely been starving cable, while at the same time trying to get more and more in affiliate fees from cable operators, and this is the breaking point.
And Kevin, Michael was just alluding to this, but clearly that media transition to streaming is already underway. But do you think this dispute could put the nail in the coffin, so to speak, when we think about the future of linear?
Yeah, certainly it's something that could accelerate the decline of pay TV. I think something that sticks out to me, in particular about this dispute between the two companies is, in one way or another, it's still affecting what consumers are able to access on video streaming services. So one of the reasons why this dispute between Charter and Disney is such a big deal is because ESPN is involved. And of course, we know that with the pay TV landscape declining, it still has a really big reach. And because of that, major sports leagues are generally still hesitant to put a large percentage of their regular season games on video streaming exclusively. So with that, consumers really need to be able to access traditional TV channels, whether that be on cable or a live TV service like Hulu with live TV, to be able to watch a large portion of live sports. And our data has shown how this is impacting consumer attitudes on video streaming previously. So last year, Morning Consult data showed that among video streaming subscribers, the one thing that they're generally least satisfied with is their access to live content, including sports.
Michael, getting back to what you ended on there, you called it a breaking point. So what does that signal then for the future here when we talk about what's at risk financially, the ad revenue, affiliate revenue that's at risk here, and then more broadly speaking, just the leverage or lack thereof that a lot of these studios, that a lot of these networks, I guess, are losing day after day at this point?
Right. It needs a classic innovation dilemma, right? Cable continues, as Kevin said, to be a huge cash cow, even in decline, while at the same time that streaming, really with the exception of Netflix, has been a gigantic money sink. So you're potentially in a kind of lose-lose situation. And it's been crucial for the studios to preserve the cable bundle, of which ESPN, as again he pointed out correctly, was kind of a linchpin. So the moment that collapses, and I think everyone knows it's going to collapse, and this feels like a breaking point, you're going to find significant losses for cable operators and for studios at the same time. So I would say it's a concern for all of us in the business.
Another story we're watching today is Warner Brothers Discovery, which warned of a $300 to $500 million profit hit for the full year amid the ongoing Hollywood writers' strike. The writers' strike is well past month 5. We have the actors entering month 2. How much worse could things get? And do you expect other media companies to also lower those forecasts? And Kevin, we can start with you.
Yeah, as you mentioned, we're in the thick of things with the double strike going on, and wouldn't be surprised to see similar revisions in earning expectations from other media giants. I think something to keep in mind with the double strikes going on is essentially with the WGA in specific, that's something that is disproportionately affecting TV writers. So the WGA's majority TV writers, with the minority being film writers, even though we see, of course, the strikes impacting both TV and film. But I think something that is important that's highlighted with WBD's revisions on earnings expectations is the shrewdness and its ability to diversify its revenue streams over the past year. So we've seen Warner Bros. Discovery be one of the leading companies in terms of being willing to license its content to other platforms. We saw it license content to the Roku channel. Recently, there was a deal with HBO and Netflix, with certain content migrating to Netflix from Warner Bros. Stable. And this would be something that would be previously unthinkable prior to, I would say, the last year, certainly when HBO Max first launched in 2020. So I think the impact of the strikes on Warner Bros. Earnings is a bit less than it would otherwise have been had it not chased these alternative revenue streams.
And Michael, what do you think? Is there a side that has more to lose at this point?
I think they both have, or all of us, I should say, potentially can lose. I think the negotiations are happening as if we're living in a closed system, but we're not living in a closed system. We're living in a world where gaming and social media are increasingly taking advertising dollars and mind share away from TV and film screens. And I think that, my concern would be that if this strike is not resolved soon, our business could get turned into AM radio. There's nothing that requires people to keep watching TV and TV shows and movies at the rate that they were previously. And I could see a version of the business that feels increasingly small in terms of its business impact and its cultural relevance compared to gaming and TikTok and Instagram.
Michael Hirschhorn and Kevin Tran, we've got to leave it there, but great as always to get both of your perspectives. Thanks so much.
Cheers.
Big tech bracing for a potential wave of legal battles in the EU. Antitrust regulators in the region are set to announce a list of big tech services that will be subject to rules amid its new Digital Markets Act. Yahoo Finance's Alexis Keenan is here with the details. Alexis, what's the impact here?
Yeah, so this Digital Markets Act, it's one of two major sweeping antitrust laws that are coming online in the EU. It becomes enforceable in March, and it purports to really promote competition in the EU through some special rules for big tech that really don't apply here in the US. For example, it makes it illegal for a tech platform to favor its own products over the products of its, for example, third-party sellers like Amazon does. Also makes it illegal for these companies to combine personal user data between their owned platforms. Also, there are some rules around interoperability as well. Now, the law really targets companies that control what the EU says are the gateways that businesses use to reach their final consumers. And some of the known targets, you can see them right there already. These are companies that have self-ID'd: Apple, Microsoft, Amazon, Google, Meta, including Facebook, Instagram, and WhatsApp, and also ByteDance's TikTok and Samsung as well there. But there is some specific criteria that makes a company subject to this new law. For example, they have to have a minimum of 45 million average monthly users in the EU specifically. Also, minimum revenues have to come in at 7.5 billion euros in each of the last 3 fiscal years. That equates to about $8 billion US. Also, they have to have a market cap of more than 75 billion euros or 80 billion US. There's also this catch-all kind of section of this law, though, that kind of throws all that out the window, and that allows the regulators to designate a gatekeeper just based on entrenched and durable market position is the way that they phrase it. And according to the Financial Times, there's already some pushback against this law. You have Apple saying that its iMessage service should be exempt. You have Microsoft saying that its service, Bing, its search service, should not be included in the law. They're just not big enough, don't have a big enough market share that they should be subjected to these kinds of rules. But as you might expect, there are probably legal battles to come. We've already seen it with these exemptions, at least purported exemptions. And there's a formal process as well that these companies can take in order to try to challenge these rules. But they might have a hard time in the EU because the sector is pushing pretty hard in this antitrust area.
Lots to keep track of. Alexis Keenan, thank you so much. Coming up, we head out to the Goldman Sachs Communicopia and Technology Conference in San Francisco as Brian Sazi catches up with the CFO of Zoom to discuss the impact of AI in the workplace. More Yahoo Finance on the other side of this break.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Yahoo Finance is at the biggest tech conference and media conference of the year. That is the Goldman Sachs Tech Conference in San Francisco. Lots of talk about AI, the future of AI, and what it means to the stocks in the tech space. Joining me now is Zoom CFO Kelly Stuckelberg. Kelly, good to see you in person for a change.
Hi, Brian. Yes, it's great to finally meet you.
Thanks for joining us. So we actually heard a presentation by your CEO a little earlier on, about an hour and a half ago, about how he wants to grow the company 4 times. How do you get there?
Yeah. So there are lots of exciting initiatives that can help us accomplish that. Of course, there's Zoom Phone, which is our cloud PBX solution, which has had great momentum. We announced on our call last week. It's crossed over that $500 million run rate of revenue. So that's really exciting.
That's a big number.
Yeah.
I remember when you first launched Zoom Phone.
Yeah, it's like about 5 years old. So it's gotten there really quickly. So yeah, very, very exciting. Lots of continued momentum there. We have Zoom Contact Center, which is our cloud-based contact center, natively built from the ground up, seamlessly integrates with voice, with video. And we announced on our call, we have over 500 customers there. That's only 6 quarters old. So that's still, maturing into its own. And then, of course, there's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment. It's not like reading a whole transcript of the meeting. It really
people know that I'm in the meeting. I don't want to go into any more meetings. Kelly, will there be a light that goes off? Brian was here, but maybe not here?
No, we're not going to do that for you. But you will, if you're not there, you don't have to call yourself out by asking your colleague to catch you up, right? You can just read the meeting summary.
So AI is being used for paying subscribers. How do you bring that down to the free user base?
Well, we want to use this as a way to motivate them to convert, right? I mean, there's lots of value you get in our free platform already, but this is one way you'll continue to see that differentiation between paid and free. You've already seen some of that over the last year where we added the 40-minute limit, for example, and this is just going to bring more and more value to our paid subscribers and really help people see that it makes sense to have this as a part of your daily workstation and not have to be constrained by any of the free lack of functionality you might get on the free side.
When do these changes start? Will I be able to flip on Zoom in a couple days and poof, they're all on there?
Yes, there are certain aspects of it that are already generally available, parts of it that are in free trial modes right now. But yes, I would say the next time you upgrade your Zoom client, you're going to start to see some of these features.
There's been different approaches in C-suites on how to factor in AI into their guidance and their outlooks. When I hear you say we're putting AI features for paying subscribers, does that change the earnings output of the business for next year?
Well, we actually also have components of our platform that are really powered by AI that are standalone SKUs. For example, we have Zoom Virtual Agent, which sits beside our contact center solution. It was really powered by our recent acquisition of Solvvy. It accelerated the development of that product. And it's exactly what it sounds like. It's a virtual agent that can respond to simple queries. Like we use it internally for our customers, and it's been amazingly effective at things like I need to reset my password. And so that is a standalone SKU, which is driving revenue for us today. We also have things like our translation SKU, which is also powered by AI, that is a standalone SKU that paying customers pay for. So there's going to be a mix of things that you get as kind of table stakes of the platform as a paying customer, and then additional SKUs that we monetize.
I feel the enthusiasm, Kelly, in this room on AI. I've been here 4 or 5 hours already, and it's bursting at the seams. Is it hard to manage investor expectations given the hype we are seeing around this technology?
I think that the hype was super high, and it is really exciting here, but I think it's kind of coming into a sense of reality now that people are coming into grips, and sort of there were unfounded fears, I think, in certain aspects of AI is going to potentially diminish the aspects of certain companies' effectiveness. And we see it the opposite, right? What it's going to do is it's going to make us all more efficient and enable us to do the things that we really love or that are really value add. And that's why, again, parts of it are table stakes in the Zoom platform so that all of our customers get the benefit of that.
There's also been some chatter in the early panels about, let's say, the the yawning influence of a competitor like Microsoft. How do you view them? Are they increasingly encroaching on your turf with Teams?
Microsoft is a great partner and a great competitor of ours. We certainly never take them for granted, but we also listen to our customers, and our customers, they love Zoom. They want to use many parts of the Zoom platform, and sometimes potentially in conjunction with Microsoft. So we have seamless, natively built integrations with the Microsoft platform where you can one click, for example, launch a Zoom meeting from the Microsoft interface. And that allows our customers to leverage the platforms in ways that serve them best.
What's the health of the small business customer?
Small business is really interesting. It's where Zoom really started. It's at the core of our roots. And we saw great performance out of our mid-market teams in Q2. They were really, I think they've rebounded, if you will, from some of the changes that we made earlier this year internally. And that makes sense. Like, those sales cycles are shorter. They've gotten back into their territories and they're doing really, really well. So that continues to be a place also that we differentiate ourselves from some of our competitors.
Early on, I had the chance to catch up with Goldman Sachs chief economist Jan Hatzius, and we've talked a lot about the health of the consumer right now, but into 2024. Jan is pretty upbeat and optimistic on the consumer outlook. But do you see that same optimism in small businesses?
Yeah, we do. Again, we saw the strongest performance in Q2 out of that mid-market segment of our business, and strong pipeline coming into Q3. So they have been, I think, a little bit less impacted by some of the downsizing we saw earlier this year. And something like Zoom Contact Center is perfect for them, right? Because it's natively built into our platform. It's simpler to integrate than potentially some of the competitors. And so those are the types of customers that don't have huge IT organizations. They're self-serving themselves. And so having a Zoom platform for them makes a whole lot of sense.
Lastly, before we let you go, I'm putting this question to every leader we talk to at this conference. What is your biggest challenge for next year? Maybe not necessarily just from a Zoom perspective, but from a leadership perspective as well.
I think as we go into next year, there's obviously a huge demand for talent around, especially AI, that everybody's focused on. We are really lucky. We've had some amazing leaders join us recently. XD Huang joined us. He's joined us as our CTO. He was formerly from Azure, and he's been great. So having great talent like that begets great talent. So I think that's going to really benefit us as we move into next year. But I think it's returning the company to accelerated growth. That's what we're really focused on in everything that we do.
All right, well, good luck at the rest of the conference. Zoom CFO Kelly Stuckelberg, good to see you as always. We appreciate it.
Thank you, Brian.
All right, much more ahead. Lots more big interviews from the Goldman Sachs Tech and Media Conference in San Francisco all week on Yahoo Finance. We'll be right back.
The Inflation Reduction Act is increasing demand for minerals critical to the country's clean energy transition, raising questions about supply of lithium, cobalt, and nickel. Rick Newman joining us now for more on this. And Rick, we're hearing more and more about a metal shortage here.
Yeah, there was a recent report by Standard & Poor's basically saying we just don't have enough of certain critical minerals here in the United States based on current production levels or anticipated production levels. So there are three metals in particular that are really important to electric vehicle batteries, for example, cobalt, lithium, and nickel, and also copper. So those first three are considered critical minerals, and then copper also very important. And S&P is pointing out that we just don't make enough of this stuff in the United States, or mine enough of this stuff here, I guess is the point. And that's important because in order to qualify for many of the tax breaks that are included in last year's green energy bill, a lot of that, there are domestic production requirements, and they get tougher over time. So in order to get the tax break, meant to incentivize the production of electric vehicles, batteries, other types of green energy, you do have to source a lot of this stuff in the United States, and it's just not here. So I see stuff like this, and it's a couple of takeaways. First of all, that green energy bill, which had the weird name, the Inflation Reduction Act, that is turning into a transformative piece of legislation that is, at this point, putting more than $1 trillion worth of subsidies into the green energy market. And really, that is really going to change things over time. But there are going to be a lot of gaps and holes that need to be filled, and opportunities for whoever can figure out how to solve those problems. And just looking at where we're going to get these critical minerals is one of those problems. A lot of other countries produce this stuff, but they're not necessarily friendly to the United States. China is one of them, and you're just not going to get the tax credit if that's where the critical minerals come from, which means you're probably not going to take a jump on the project. So this is one of the problems that needs to be solved. People also wonder, all these new factories are going to have, where are the workers going to come from? How are they going to get trained? So interesting things are happening, but we got a lot of work to do.
Certainly a lot of work to do, a lot of challenges ahead, but we'll see whether or not we're able to resolve them. The industries are able to resolve them in timely fashion. All right, Rick, thank you.
You, Shauna.
Well, coming up, we are counting down to the closing bell in just about 11 minutes. You got the Dow and S&P still trading in negative territory. The Nasdaq now back just above the flat line. We'll be right back.
Welcome back to Yahoo Finance Live. Breitling Watches, the nearly 140-year-old Swiss watch brand, is still around and still ticking and looking for more growth. Joining me now is CEO George Kern from the newest location here in New York City. So George, talk to me about Breitling, the story. You guys are growing, sales are up. What's going on there?
Well, first of all, CVC came into the company, which is a private equity company 6 years ago, to invest in this brand, also with new management. We have another majority shareholder since a couple of months, which is Partners Group, which is a Swiss private equity company. So we have been doing very well. The valuation has been increasing. The brand has been growing tremendously over the last 5 to 6 years. And yeah, we're very happy about the results and the development of this company.
So George, I understand Breitling is now in the top 10 of the Swiss watches in terms of exports, and you guys are expanding also the retail footprint here in New York City with this meatpacking district, new brick and mortar location. Why is physical retail so important for the brand?
So it's true, we have now 230 boutiques around the world. We have roughly 25 boutiques in the US. We have 4 boutiques in New York. People want to live the experience. People want to have the 360 of the brand. They want to talk to our great colleagues here. They want to understand the brand. They want to see the whole collection. And in particular, young people want to see it. And it's still a physical purchase. So it's not about e-com. You get the information on e-com or on the web, and then you buy physically in boutiques.
You know, a lot of new watches for Breitling recently, this year and also last year, but also you're wearing one right now, a special watch right now. Tell me about that watch and please show our audience, yeah.
So this is Top Time, which we do in collaboration with Deus Ex Machina, which is a motorbike and surfer brand from Australia, actually. It's very cool and it reflects exactly our design philosophy, which is modern retro. So we don't want to be vintage. We're a modern brand, our movements are top notch, but we have this little vibe of retro, which you see in this kind of collaboration, which you perfectly see in this boutique, and with other partnerships like, for instance, Triumph Motorbikes.
Yeah, I noticed here in the boutique here in the meatpacking industry, you have the coffee bar, the downstairs lounge, things like that, the importance of retail, but also, you know, talking about retail, I want to talk to you about sort of Rolex, right? The biggest player in the space right now. They went in with recently buying Bucherer, the big retail operator, owner of Tourneau. What does that mean for an operator like yourself who has their own retail space, but also works with Bucherer as well?
No, we love this collaboration with Bucherer. We have been working with them since many years. Rolex is a great company. I would qualify them as really, they have the best possible behavior in the industry. They respect all the other brands, and I'm very happy about this acquisition. And as far as I understand, nothing will change for us and for Bucherer in this relationship.
So looking kind of at the industry in general, the big picture of the Swiss luxury watch industry, we're seeing some softness in the secondary market there for used watches, some of these bigger and higher end grail watches they're called. What's your take on that, and how does that affect sort of the new first-hand market?
So first of all, the analog watch industry has been booming for the last years and will continue to grow like crazy, because we're nowhere still in China, in Indonesia, in India, in many countries where the industry is just starting. The last 2 years were particular. We had this, what we call post-COVID situation, or these revenge buyings after the confinement and everything. And today, I think the market is just normalizing, but it's still growing, and yes, but normalizing still at a very high level.
Yeah, do you think that post-COVID bump has sort of changed the watch consumption behavior? People want to buy more watches, they want to take pictures of them, put them on Instagram, go on vacation. Is that a new change in the industry? Have you seen that with your customers?
Yeah, I think we live also in an age of overkill of digitalization, and having an analog watch, a very traditional watch, handmade, which you actually intellectually can understand because it's like a Lego. You know, when you look at a movement, you can understand how it works. I think it's something very human, and people like that in this age where you have catastrophes, where you have bad news every morning, where again, you know, it's an emotional product in this digital age, which people like to buy, And therefore, this market, in particular with young people, is tremendously growing.
You mentioned that analog sort of effect with watches and how people sort of gravitate towards that. What's next for Breitling now? Is it expanding to other markets? Is it a geographic expansion, or is it new products? What's next for the company?
Well, we always launch new products. Actually, we're launching a new product tomorrow night in the ladies segment, which is a huge. I mean, it's 50% of the market, and there's something we can do here. It will be a very cool product. We want to be the cool and relaxed alternative for the men's market, but we also want to be the cool and relaxed alternative for the females market. So therefore, there will be a product which we are going to launch tomorrow night with a couple of our celebrities and friends and ambassadors of the brand.
You guys watch this space. Some new watches coming out, maybe some new ambassadors. We'll see. But one quick follow-up, last question for you. I know you're a man of varied interests. You collect motorcycles and I know sunglasses and things like that. But you're also a fan of famed investor Warren Buffett. What are some of the things that he's taught you or what you've learned from him that you sort of appreciate and you can kind of impart to other people?
I don't know where you got that, but it's true. It's true. I admire Warren Buffett because he's such a nonsense guy. He's so modest. He's so sharp. I watch all the YouTube videos. I love his quotes. I use them in my own presentations. And if there's one person I would like to meet one day, it's Warren Buffett.
George Kern, we might try to make that happen, right? We can try to make that happen with Yahoo Finance. George Kern of Breitling, thank you so much for joining us. Back over to you, Shauna.
Thank you.
All right, Praz, thanks so much. All right, we are just about 45 seconds here until the bell. And let's take a look at where things stand right now. First, starting with the major averages, because we're looking at pressure here across the board. The Dow off now just about 200 points. Among the worst performers in the Dow today is Walgreens. That stock under pressure this afternoon. You have the S&P falling just below 4,500. We know that that is a level that investors have been watching here, as we briefly did trade above that level there. And the Nasdaq now off just below the flat line. Taking a look at the sector action here. Some pressure across the board. Energy, though, we've got to note, energy bucking that downward trend as crude closed at its highest level that we've seen in just about 10 months. All right, well, that's a closing bell on Wall Street, and this market check sponsored by Tasty Trade. But let's do a check here of some of the individual movers. And first up, taking a look at Warner Brothers Discovery, warning that it could take a hit of up to $500 million because of the Hollywood strikes. We know, obviously, Ali, that this is a massive issue for studios, for companies here. They're being forced to delay some of their films. Warner Brothers becoming one of those companies, saying that it has now delayed Dune here until 2024 because of the ongoing strikes. And still, you've been reporting about these negotiations, about these talks, but still both sides failing to really find an agreement, a common ground.
Yeah, talks hit a snag a few weeks ago. It seemed like finally we have both sides coming to the table here, but that ultimately ended in no deal, and talks have not resumed since. Now, with Warner Brothers Discovery, they released a regulatory filing earlier this morning, as you mentioned, warning of that $300 to $500 million hit. Also lowered that full year EBITDA forecast to $10.5 billion to $11 billion. That's down from the previous low end range of $11 to $11.5 billion. And WBD said this is predominantly due to the strike. So we're seeing the impact here. You mentioned that Dune 2 delay. That's going to have a hit to not only Warner Brothers Discovery, but the box office as a whole. And there's a lot of question marks when we think about the future of the box office schedule and what that release calendar will look like. That was a problem that we faced during the pandemic, and even post-pandemic. We're still not back to those 2019 levels. So this is just another thing that the box office is going to have to worry about.
And it was also interesting. There was a silver lining in this report. They talked about the success there of Barbie, and that's going to help their free cash flow. And we talked about how big Barbie has been. It's been obviously a massive hit. Whether or not that was going to be enough to bring people back to the movie theaters, do you think that's actually going to last here?
I think Barbie was a one-off event. Yeah. I think it's really hard to recreate the magic that was Barbie. Just the marketing around it, the promotions around it. It was amazing. That red carpet with Margot Robbie dressing as different types of Barbies. It really hit every single button there to make it a giant success. I don't think we're going to see that through the fall. If you take a look at the calendar, Dune was the big one.
Yeah.
Now that's not coming until 2024.
Yeah,
so
certainly.
Something we'll have to continue to watch. Similar to the box office being under pressure, WeWork shares are under pressure today. The company's 40-to-1 reverse stock split going into effect today. You're seeing shares closing down a whopping 19%. And Shauna, this is just a company that has had a disastrous run as a publicly traded company. If you recall, at one point, this company was valued at $47 billion. Today, it's below $3 billion, trading as a penny stock at this point. They have said they are looking at different types of ways to turn the business around, negotiating more favorable lease terms, generating new sales, seeking additional capital efforts, but it's hard to know where this company goes from here.
It is very hard to know where this company goes from here. And when we talk about why they made this move, they did it so they could still stay listed on the New York Stock Exchange. When you take a look at some of the rules, some of the guidelines from the NYSE, you have to have a closing price above $1. So they did this as one of their last-ditch efforts here. They're trying to turn around the business, but we know WeWork is not alone when you take into account the pressure that we are seeing in the office space right now. So many companies, obviously WeWork having an outsized impact because of this, but so many companies trying to figure out what they're going to do with their office spaces. WeWork dealing with elevated costs, a cash burn, that high turnover rate. People simply are not renewing their memberships here with WeWork. So the company has it very, very, very challenging, several months ahead of themselves. They talked about that turnaround strategy that you mentioned, saying that it's critical that they execute on that in order to stay in business. So we'll see what happens here for the future of WeWork. Let's also take a look at MasterCard. Now, MasterCard denying reports that it's planning to raise credit card fees on merchants. Bloomberg and the Wall Street Journal previously saying last week that the company was going to start charging retailers more starting next month. We're looking at MasterCard closing off just about 1%. Now, we talk about the massive run-up in fees and what some of these credit card companies, MasterCard included, charge these vendors, charge these third parties in order to use credit cards. Clearly, that fee level has been climbing very, very steadily over the last several years. And it means something to consumers, too, because a lot of time merchants are being forced to pass along some of those higher costs to consumers in the form of how they're pricing their products in order to offset some of the pressure from fees. But MasterCard coming out saying that, at least for right now, they don't have plans to raise their fees.
And that was my question mark. Is it going to happen later and it's just not going to happen now? But as we're mentoring, I mean, these fees are so high. Merchants in the U.S. paid an estimated $93 billion in both MasterCard fees, along with Visa fees as well. And Visa also said that recent press coverage on the issue was, quote, misleading, and that its fees on Visa transactions have been flat for the past decade. So good news for merchants and the consumer, as you were mentioning, especially considering this macro environment is so uncertain right now.
Yeah, extremely uncertain. All right, let's talk about another company here in focus. Well, as interest rates continue to rise and impact both consumers and merchants, buy now, pay later companies are finding it challenging to produce any profit. Klarna, though, one of those buy now, pay later businesses, did see 1 month of profit gains in the first half of the year. They're still, though, trying to build on that to return to steady profitability. Here to discuss that and more, we want to bring in Klarna CEO Sebastian Siemiatkowski. Sebastian, it's good to have you back here. So really, you're really bucking the downward trend that we're seeing more broadly speaking within the space. There were so many critics out there saying that now is an extremely tough time for companies within the buy now, pay later space. You're actually doing pretty well. How?
Well, yes, thank you. It's actually, well, the thing is that, not a lot of people know, but, the company was profitable up until 18-19 when we started investing heavy in our expansion to the US and some new markets. We're still generating in Europe about $1 billion of gross profit annually. And now finally, we've been able also in the last 12 months, since kind of investment sentiment shifted and people wanted to see more profitability than growth, we have been focusing on optimizing and getting our US business to that level. So now we've seen 3 quarters of consecutive profitability in the US market as well, which is very, very exciting.
And one thing we're watching closely here at Yahoo Finance is the expiration of that student loan moratorium. How do you expect that to impact your business?
Well, the point is that, I think, one thing that is fairly misunderstood in media around, the buy now, pay later products that we offer is that they have been built with customers' best interest at heart, right? So we don't offer revolving. We only offer installments. It's fixed time. We try to always give you both a debit and a credit option as opposed to a credit card. So everything is on credit. So the average outstanding balances in the US are about $120 to $150 compared to $5,000 for a credit card, which means that we have a very healthy consumer that is using credit very responsibly. And you also, because we underwrite every credit decision in real time, when a macroeconomic change as we're seeing right now is coming, it actually takes us only 2 months before we have underwritten half of our balance sheet according to the new model. So it's a very agile business model compared to a bank that may take 3 years before new underwriting rules actually affect a majority of the balance sheet. So this is why we're seeing 30% losses below credit card industry standards, and gives us an opportunity to be much more agile in a macro environment like this. So actually, we do not expect any of those changes that you mentioned, like the student loans, having any significant impact on our loss rates, even though they may obviously have so on the bigger macroeconomic environment.
So Sebastian, you still see, it sounds like you still view the customer here as in a very strong position despite some of those headwinds that we've been talking about.
Well, very much. I think, the important thing, obviously, and you see that very clearly in the US, is that unemployment has not risen yet, right? And in general, if you look at people's long-term, economical situation, employment is the critical factor. As much as obviously interest rates increases may mean that spending shifts a little bit, that there's a different, portfolio of spending than there was, and people may be a little bit more, careful in their spending. In general, the loss rates for them to increase, we would have to see a significant increase in unemployment rates as well.
Sebastian, what does that shift look like? What are people spending on now that they weren't 6 or 12 months ago?
Well, I do think that still we're definitely still seeing, e-commerce suffering from a little bit of coming back to normality, right? So for a while there during COVID, we thought that e-commerce would be, 90% of people's spending or something in the future. Now, what you are seeing though is also that, obviously in the US, there were the checks, and people's savings rates just went through the roof. People were paying down their debt at a massive rate. I mean, you saw Amex had one of its worst quarters during COVID because they are so related to kind of travel spending, restaurant spending, and now it's kind of the reverse, where Amex has posted some of its fastest growth. It is in those categories. Restaurants and travel is actually still, in some sectors doing quite well, even though you do see overall a slowdown due to the recession. So consumers are a little bit, in my opinion, better off than what, maybe the impression that you get from media is.
Sebastian, you mentioned that macroeconomic environment quite a few times here. I want to read this quote from the earnings call. You said, some claimed Klarna would face difficulties in the tough macroeconomic climate with high interest rates, but having led the company through the 2008 financial crisis, we knew we had a strong and resilient business model to see us through. What did you learn from 2008 to help set up your business?
Well, when we started the company, we were simply providing a digital alternative to classical retail banks and card options. And we copied a lot of their business models where we had a too big dependency on late fees. We had too much revolving credit, which revolving to me is one of the worst concepts because people don't really understand revolving. Like, what am I paying and when am I ever going to pay this off? And people build balances. So one of the things that we started experimenting with and trying to learn was to find a healthier credit model, one that would both give consumers an option. And there's a McKinsey study in the US that showed about 20% of the credit card population in the US is very tired of all the dirty tricks of I always recommend to watch Credit Cards Explained on Netflix. Is it'll take you through all the tricks that the banks have been doing on us. And so there's a big part of the population very tired of those tricks. And so if you build good products for them that they enjoy and that are more friendly and not trying to push you in too much excess debt, then as a consequence of that, you also get, better performance during a tough environment because you simply have people using it, more responsibly as well. So this is very obviously different than the impression people have of buy now, pay later in media. But actually, if I compare our credit products to, the credit cards, they are simply better for consumers.
Sebastian, you've jumped in on the recent AI excitement lately here with a number of your investments being in the AI space right now. How does it, though? We talk a lot about companies maybe mentioning AI here and there on their earnings calls, but it's not really impacting their business, helping their revenue, their bottom line here, or top line down the line. How do you see it helping your business, helping Klarna financially?
I'm so happy that you asked that question because I think that's exactly what it is. There's so much noise and people are talking about this and that and making press releases. We have internally had about, I think, 2025 more kind of serious AI initiatives which are targeting different areas. And we just I think it was in May, took our first one live that has already, by removing basically fairly boring, unnecessary work elements that were just boring for people to do, but saved a lot of time. So I think we've already seen, about $4 or $5 million worth of savings on an annual basis in unnecessary. So this is very concrete to me. It's real. it's real efficiency gains that's coming out of this. And then you obviously have to be mindful of the privacy aspects and a lot of other things that are consistently being mentioned. And yes, it's not, if you want to use it for math, don't use it for math. It's not great for math. Like there's things that, people will write, oh, I didn't do 2 + 2 correctly, whatever. But if you apply it correctly, there are already very concrete gains from efficiency. And then also we obviously have a very exciting amount of products coming out soon that we think will have also material impact for our consumers. But even just like, a few $1 million is quite good.
It is quite good. $2 million because of some of these investments. Sebastian, always great to have you. We look forward to having you back on Yahoo Finance soon. Thanks.
Thank you for having me.
All right, well, coming up, Yahoo Finance's Brian Sozzi is at the Goldman Sachs Communacopia and Technology Conference in San Francisco. After the break, he will sit down with Goldman Sachs Managing Director Brett Feldman about the current state of streaming. Stick with us. That's next on Yahoo Finance.
Coming up, Yahoo Finance will travel far and wide to bring you the story. So we sent our most intrepid reporter to one of the world's most innovative cities, a man who needs no introduction. Okay, Stan Howley. Find out what he's up to on Yahoo Finance's next.
is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. We're still live at the Goldman Sachs Tech and Media Conference in San Francisco. And the other undercurrent at this conference is, in fact, all things happening in media. Lots of focus, of course, on AI, but that other undercurrent is media and what may be happening next. And to that end, Brett Feldman is here, Goldman Sachs Managing Director covering telecom, cable, and media. Thanks for having us to your conference, Brett. We appreciate it.
We're so excited to have you here. This is one of the biggest events we do all year. We're going to have the senior leaders and CEOs from over 200 global TMT companies. It really should be a great couple of days.
No, it's already shaping up to be that way. And a lot of the chatter in the room is the situation between Charter and Disney. And my question to you is why is this happening right now?
That's right. So just for your viewers who I think probably know by this point in time, if you're a Charter customer, so if you have Spectrum Cable, you can't get any Disney channels right now. They've been removed from the service, and that includes ESPN. So you made a great point. We have been seeing the number of households that pay for cable and satellite TV bundles decline for years. Why are we now just getting to this point where the distributors, the cable companies, are really pushing back? There's really 2 reasons why. The first is we're going to see the total number of households that pay for TV this year decline by about 6 to 7%. About 2 years ago, that was negative 5%. A couple years before that, it was a much more moderate number. So this has been an accelerating pace of decline. The reason why 6 to 7% is interesting is that historically the media companies like Disney, have been able to raise the price of their channels by about 5 to 6% per year. So we've hit this tipping point now where the media companies simply can't raise prices fast enough to offset the loss of pay TV subscribers. I think that has emboldened the cable companies to look at this relationship and say, listen, we can't absorb these historical price increases. We need to talk about a new model. That's one of the things that Charter talked about. Another point Charter made is a point we actually started making about 4 years ago, which is that they've reached what they call a point of economic indifference. Basically, they're saying we almost don't care anymore whether our customers decide to pay for a channel package or not, because they've lost so much profitability in that business as a result of cord cutting. They really make all their money now providing internet service. And so I think that you have the cable companies saying, we can't do this anymore. We were able to deal with it for a couple of years when we were losing a small number of customers. But as this snowball continues to roll down the hill, we have to come up with a new model.
At the end of the day, when this comes to an end, and it inevitably will, who is the biggest loser? And what does it mean to the broader media landscape?
It's a great question, and actually we're going to be asking a version of that question to all these CEOs of the big media and cable companies when they're here this week. And really the question we're going to be trying to get an answer to is, what's a win-win? If the model that we've had before, the relationship between the media companies, between the cable and satellite companies, and the relationship that they ultimately have with their viewers, if that's not working anymore, what is going to work? And are there other things that have to change? Maybe the way they price their streaming services in order to get something that works for everyone involved, including the consumer.
Do you agree? I think it was last week, Barry Diller at IAC said the streaming companies, they're not your friends. They're your enemies. Is the ultimate problem here companies like a Netflix?
I think Charter has been trying to make that point. Their view is that the media companies have devalued their entertainment by moving on to streaming platforms. And they give examples of it. They say, historically, you've been able to capture some of that value through advertising. You're barely doing any advertising on your streaming platforms. It's a new thing and you're not doing a lot of it. There's no security. It used to be that if you wanted to watch what was on cable TV, you had to pay for cable TV in your home. I think we all know that password sharing has become a big deal. Netflix has recently started cracking down on that, but not all the media companies have. And just in general, I think that the distributors, the cable and satellite companies, they look at what they're being asked to pay to make that content available to their customers, and they look at the price that those same media companies are charging to make it available on a direct basis. They say these are not the same prices. There's got to be a way that we come up with a sustainable economic model we can all agree on.
Is there any appetite to own these media stocks, and what has to happen?
Well, I think there is, in part because they've been under so much pressure. A stock that we have talked a lot about is Warner Brothers Discovery. David Zaslav, the CEO of Warner Brothers Discovery, will be here tomorrow. They are able to do something that some of the other media companies cannot, which is that they're still integrating a very large merger. They had acquired the Time Warner assets, the old Time Warner assets out of AT&T about 2 years ago, and they quickly realized there was a lot of inefficiency in how that business was run. And so they have an opportunity here to keep taking costs out of the business and hopefully make the products better at the same time so that they can generate cash, they can pay down debt, and ultimately do something that should be accretive to their shareholders by positioning the company to be a winner in the streaming wars. But to be fair, it's a highly debated sector. That's a highly debated stock.
Not lost on me, Brett, is last year Bob Chapek was here, now former CEO of Disney. Disney CEO Bob Iger is not here. Of course, there's always scheduling conflicts, et cetera, but to me, I think it says a lot that Disney's not at this premier conference, and it says a lot about the challenges they're going through. What has to happen to get investor appetite back into a stock that's about 52-week lows, despite the content power that is Disney?
Well, Disney's been here for a number of years, and so it would have been great if we could have made the scheduling work, but we'll hopefully have Bob Iger back. There's a few things they have to do. They have to demonstrate that they can continue to be on a path to profitability in streaming. So one of the nice inflections that we've seen since Bob Iger returned is that the losses they've been incurring in their streaming business have begun to compress very significantly. So proving that they can make money and then give some indication as to what those margins can be over time, I think that's really important. I think in their traditional media networks business, which really revolves around ESPN, they have to show that they can transition ESPN from being a package of cable and satellite TV channels to being something that you can subscribe to on a direct basis, meaning something you could stream. A lot of people may say, well, hold on, can't you get ESPN Plus right now? You get that in your bundle with Disney Plus. It's not the same thing. It's a niche product. They haven't put the full suite of sports rights that they have access to into that product. If they can do those two things, they will really be able to demonstrate that they have a strategy and a model for taking what is a very profitable, historically very profitable media business and turning it into a profitable streaming media business.
I mean, Bob made a lot of headlines a couple months ago suggesting everything was on the table. What's the end game here for him? Is it a spin-off of ESPN? Is it a sale of those linear TV assets?
I don't think we know. I thought what was refreshing about those comments, I think some people heard him as a little bit alarming, but I think that what was refreshing was to hear him acknowledge that everything is on the table. If you go back a few years when cord cutting wasn't quite as intense as it is right now, in some cases you would hear media companies talk about this being manageable, taking a very long time, not likely to get any worse. I think investors were always very skeptical of that. To hear a leader in the industry like Bob Iger acknowledge that you have to put everything on the table right now, I think shows how seriously they're taking this and is a real signal to the street that they're going to do what they need to do so that Disney can have another 100 years of success in the market.
Are investors waiting for that big move to get back into the stock? Do they want to see him pull the trigger on something mind-blowing?
I don't know if it's one thing. I think you have to look at this and say, as he's returned to the company, he has made the adjustments that are necessary to put the company on the path they need to be on. Because what investors really want is they want to see a company that can execute its way to success. And if you're still debating what they're supposed to do, that can be an overhang on the stock. So the main thing is setting a strategy and then setting a strategy that the market thinks will work if you execute it.
Along the lines of Disney at a 52-week low, I look at Paramount. You still rate the stock a sell, right? What has to happen to get investors excited about that name?
Paramount faces a lot of the same issues that Disney faces, a lot of the same issues that Warner Brothers Discovery faces. One of the things that they are very committed to is continuing to invest in their streaming platform. So whereas many of the other media companies have already moved past peak investment, meaning that they're getting closer to breaking even, not farther away. This year, Paramount will probably see their peak losses, meaning they're still leaning into the investment. To their credit, the service has been much more popular with viewers than I think a lot of people guessed. And they've had some real hits. They've put the NFL on the platform. So I think they feel very good about the subscriber momentum. What they have to be able to demonstrate to investors is that they can not only pivot away from being in an investment phase, but accelerate towards making money in their streaming business, because they, just like everyone else, are going to see their legacy networks come under increasing pressure.
Brett Feldman, Goldman Sachs Managing Director, covering telecom, cable, and media. Thank you for having us at your conference. This is one of our favorite ones by far.
Oh, thanks for being here.
Appreciate it. All right, more from Yahoo Finance straight ahead from the Goldman Sachs Tech and Media Conference all week long. Do tune in. We'll be right back.
Let's do a quick check of the market sponsored by Tasty Trade. We saw all three major indices close in the red today after investors enjoyed a long holiday weekend. We saw the Dow lead those declines, down 195 points. The S&P 500 closed down about 0.4%, while the Nasdaq reversed earlier losses to close just below the flat line there. The declines come after oil prices hit their highest level in over a year, while new sluggish data from China continue to show a difficult recovery story for the world's second largest economy.
All right, so time now to take a look at some of the trending stories, top stories that are at least on our radars here over the next couple of minutes. So guys, first up, we have Josh Schaefer joining us here. Obviously, Alexandra Canal, still part of the convo. And let's start off with housing. Ali, you were just mentioning some of the movement that we saw today in the market. Home builders were on the move, this time to the downside. We've seen a massive run up since the start of the year, given the fact that home builders are positioned relatively well in this environment, in the current housing landscape right now, with the fact that people simply are not moving. They're not selling their homes if they're in existing homes. So would-be buyers relying more and more on new homes. But this all points to this phenomenon that we have seen within the housing market, right? We have mortgage rates above 7% for the third week in a row, okay? Obviously, that means that if you're buying out there, you're a would-be buyer, you're paying more on a monthly basis there for your house. Then the flip side of it, people aren't moving because they've locked in those lower rates, and that's pushing up housing prices. So everyone's trying to figure out what exactly is going to happen to the housing market. And I don't think anyone really has a clue at this point.
No, mortgage rates are bad, inventory is bad. It seems like there's a lot going against the home buyer right now. And I am a millennial. I am starting that process of trying to purchase a home, and it makes me think that there's going to be a generational gap with who owns a home. I could see millennials just renting forever because we can't afford a home, and you wonder what ripple effect that could have down the line. But I recall Barbara Corcoran, I know you've spoken with her before, and she said you can't time the market and just to get in when you can, even if mortgage rates are at their current levels.
You are seeing the trend play out, though, with those high mortgage rates, just in some of the economic data points that we watch, right? We have those mortgage applications that are coming out tomorrow, the weekly mortgage applications. You've seen them down pretty much over the last month, and I don't think that that's unrelated to the fact that we've seen mortgage rates over 7%. And the other thing I think that's interesting to think about too is just overall housing prices and what people are doing with their houses that got in at 3 or 4% or maybe even less than 3% mortgage rate before the pandemic. The housing prices went way up, right? There was interesting research out about a month ago from Wells Fargo saying that that might be the next line of consumer spending, being able to use your home equity line. And so you wouldn't want to move if you're going to use your home equity line. I think there's just a lot of people that want to hold on to the value of their house that they've seen skyrocket up too. It's part mortgage rates, but also part my house is worth a lot more than it was 4 years ago.
Sell it then, so you can see those returns,
and then pay a 7% mortgage rate? No.
But then if mortgage rates start to go down, which hopefully they will at some point, does that mean the pricing will start to go down?
Well, exactly, and I think that's what we all need to figure out, right? Because Josh, you just mentioned home mortgage applications. Obviously, they're dropping compared to levels that we've seen in the past because of those higher rates. But home prices, they're not falling. Redfin was out with a report saying that in August, prices were up 5% on a month-over-month basis, and it was the biggest jump that they've seen in just about a year because some people are still out there buying, whether or not they're being forced to move or they are just simply saying that now we want to move and we're actually not going to stay on the sidelines and we're going to do it. So there's still demand is still outstripping supply. So I think that's what everyone is trying to figure out. And then, of course, Ali, like you said, what's going on in the rental market, people who cannot afford or don't want to buy, given the fact that home prices are near record highs, given the fact that mortgage rates are at the highest level that we've seen in just about 20 years, they're staying, they're renting, rental demand is very high. So you're paying more on a month-to-month basis on something that you're going to get no return for in the past. And you can see,
what does paying that rent matter? Yes. Like, how does that hurt you too, right? As you're paying more rent, then you're going to have less ability to buy later on. It's interesting how that spiral maybe plays out, right?
Oh yeah, and I'm renting right now here in New York City, and a little piece of my heart dies the first of every month when I know I'm just flushing that money down the toilet. So
yeah, it's expensive. I can still afford Apple Plus, though.
I was like, you guys are both so young, though. You shouldn't be in a rush to buy.
Thanks, Shauna.
Yeah.
So I can keep splurging on Apple Plus to watch Lionel Messi, you're saying?
You're not going to be splurging too much on Apple Plus, but it's going to be a little bit more.
$6.99 a month, and a lot of people ended up actually getting Apple Plus over the last month. It's a story I've been following very closely, is the addition of Lionel Messi to Inter Miami and how many people that then puts to Apple Plus, which streams MLS for the first time over the last 2 years now. 110,000 new signups on July 21st when Lionel Messi played his first game for Inter Miami. You can see there up 280% versus the first day of the season. And there were 6,000 signups the day before, guys. 110,000 signups on the first day he played. Just interesting to see this get an actual number. Mm-hmm. We know there's been a lot of excitement. We've talked about the potential impact, but for Apple to actually gain that many people onto the platform, then maybe they like something else. You actually keep them on the platform. Interesting to see maybe that investment paying off. I
was going to say, if they can keep them, right? We talk so much about subscriber churn, how much people are paying on a month-to-month basis. There was a recent journal report saying that people are expected to pay about 25% more this year in their streaming service than they did even just a year ago. So yes, this is an impressive number. You would think, at least at the start, that this is a massive win for Apple Plus, considering that they decided to go for one of those cheaper options getting into live sports compared to some of their rivals within this space. But whether or not people stay and whether or not Apple's going to be able to charge maybe a little bit more in the coming years is the big question here.
Yeah, when you talk about churn, which is consumers ditching their streaming plans, one thing that can help with that is live sports.
Yeah.
Is live news. That's why we're seeing Warner Brothers Discovery lean into CNN Plus, Disney taking ESPN fully over the top as a direct-to-consumer streaming service. Sports and news creates a stickiness on the platform that analysts say will cause people to stick with their plans more, rather than a Netflix, for example. You watch the new season of Stranger Things, you're not interested in anything else. Well, I'm going to turn that off and maybe subscribe down the line when there's something that interests me. You could argue that you could do the same thing with sports once your season ends, once the playoffs are done. Maybe I have no use for that. But I do think the price point is interesting, which you brought up too. Very cheap price point. ESPN Plus already talking about pricing between $20 to $30 once they bring that fully over-the-top platform to market, which should happen 2024, 2025. So I think pricing will be a big
Apple
factor
can keep
there.
that price relatively low too, you would think, because they only paid $250 million a year for MLS, which I say only, but that's significantly lower than saying paying $1 billion for one NFL game.
And it's not their main driver of the company.
I mean, they didn't think the MLS was going to get messy when they made this deal either. Talk about a little bit of luck. I think that's helped them out here. This is a pretty big tailwind for them to have.
It is, and I also wonder whether or not Apple's also reevaluating or evaluating further kind of their position right now within live sports. They certainly have been more conservative going after the MLS. Talks that obviously they have very, very deep pockets. They could afford to strike one of these larger deals with the more popular league. So whether or not maybe they're seeing this pay off, and if they're now saying that, hey, sports make a heck of a lot of sense. If we want a bigger presence in streaming, if we want Apple TV Plus to grow by X amount, then live sports may be the key in doing so. So I don't know, it could be exciting things ahead for them.
Yeah, well, Lionel Messi, a powerhouse, another powerhouse that we've been talking about a lot. Barbie, the phenomenon that is Barbie. Not only is the film outperforming, but their album is outperforming as well, debuting at #2 on the Billboard 200, multiple singles. And I want to point out too that this was a global effort. There are global artists featured on this album. It was released through Warner Music, so a holistic approach from Warner Brothers Discovery, which also produced the film. And I think TikTok, YouTube, that's been a big driver for the popularity of some of these songs, especially the newer ones like Dua Lipa's Dance the Night. We also saw the resurgence of some older songs like Matchbox 20's Push. And if you saw the movie, that was a scene that stuck with you. And that song was from the late 90s, so that making a resurgence as well. And I know that you did a little experiment.
You guys have been hosting the show for the last hour and a half. I've been listening to the Barbie album.
Must be nice.
Doing a little market research.
Yeah.
Didn't love it.
Shocker. I was going to say, someone's been questioning Barbie ever since we started
The same person that hasn't seen the movie
it.
didn't love the album. But the one thing...
Not even certain songs?
Well, I like the Barbie Girl song, the Nicki Minaj song.
Okay.
I think that one's good. I've heard that one on TikTok.
That's surprising, actually. Out of all the songs.
It's really surprising.
You liked that
one. But I did bring a trivia question, too, because I was curious about this. What do you guys think the most downloaded, or I guess bought, because it's going back to before we downloaded albums from a movie is? The most downloaded movie soundtrack, most purchased movie soundtrack. Any ideas?
Question.
I have no idea.
I know like Armageddon makes me think of...
Armageddon's a good one.
Whitney Houston's The Bodyguard.
What?
Okay.
Because do you know what song was the headline of that?
One that got 45 million copies that were sold.
I Will Always Love You. Whitney Houston sings in that movie. But it did sort of remind me of what I like more about some movie soundtracks, which is when you have a very talented musical person, it makes for a really fun soundtrack because you get a bunch of originals out of it. Think like A Star Is Born with Lady Gaga. I really like that soundtrack more. That was the thing I didn't love about the Barbie soundtrack. There's a Ryan Gosling song on there, but it's not that good.
Yeah, but
like the actors weren't singers. So it's fun when the actors...
Ryan Gosling was a singer when he was younger.
He's not Lady Gaga. He's not Lady Gaga.
But it was cute and funny, and that was the whole point of the movie, being cute.
Well, I haven't seen the movie, so I'm basing it off not seeing the movie.
But I think it also just speaks, right, to the fact that movies here can just play such a massive impact on the music industry in terms of sales, in terms of resurrecting some of those older songs, like you just said with Matchbox 20, and really even finding new stars. We've seen that happen time and time again with releases that have happened in the past and what that could mean for artists going forward. I have also not seen the movie yet.
Oh my gosh.
But I've heard a lot of these songs. A lot of them I've discovered via TikTok. So here we are. In 2023, with the massive success, obviously, of TikTok, so many people finding these trends on that. And I think that also just unlocks future gains here for the music industry and movie tie-ups.
It gets to the music trend that we've talked about a lot, right? With the fact that you hear it now on TikTok. You and I both haven't even seen the movie, and I knew half the songs, so I'm like, I've seen it on TikTok. Right.
Right. I mean, I just remember Dreams with the cranberry juice phenomenon. I'm a big Fleetwood Mac fan, and the fact people are calling it that TikTok song really got me. But hey, if that exposes it to a new generation, I'm all for it.
There we go. All right, guys, we got to leave that there. But coming up next, Steve Ray here on Yahoo Finance, we're going to head back out to the 2023 Goldman Sachs Communicopia and Technology Conference. Brian Sazi is going to catch up with Goldman Sachs Chief Economist Jan Hatzius. That comes up right after the break. Stay tuned.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
One of the biggest unknowns in the economy right now is what will happen to the U.S. consumer in 2024 as they try to navigate everything that the Fed has done as pertains to interest rates. Who better to ask what will happen to the consumer than Goldman Sachs Chief Economist Jan Hatzius. Jan, thanks for taking some time. Very busy tech conference here, and you are out of the chute with 2 big notes here today. First, lowering your recession odds to 15% from 20%. Why now with that move?
Basically because of continued improvement in the indicators of rebalancing. So the economy has continued to be pretty resilient. We're growing at 2% plus. We think that's going to be true in 2024 as well. Income growth looks supportive. Job growth is still pretty significant. And at the same time, the labor market has gotten more rebalanced. Job openings have come down, quits have come down. Wage growth decelerated. You saw that in Friday's numbers in the employment report, and inflation has come down. So I think there's increased evidence that we can see rebalancing of the economy, inflation coming under control, and it's not going to require a recession. So we've progressively reduced our recession probability. We had it in the 30%, 35% range around March when you had the financial turbulence and the banking turbulence. Always thought that it was less likely than 50%, but I've gotten incrementally more confident that recession can be avoided.
Does this quantify as a soft landing for the economy?
Yes. In fact, the note that I published yesterday, I titled it Soft Landing Summer because the evidence that has accumulated, especially over the last few months, is very much consistent with soft landing.
A lot of folks that have been reading this note and consuming it on the Yahoo Finance platform seem to be asking this question: what's the impact of the Federal Reserve's rate hikes? Doesn't that hurt growth at some point?
Well, I think it has hurt growth. They've hiked the funds rate by 525 basis points. That did reduce growth in the past year, we think to the tune of, as much as 1.5 to 2 percentage points in the second half of last year. But the lags of monetary policy, according to our analysis, are relatively short. And the biggest impact of this of these rate increases now is behind us. And we can see that, for example, in our financial conditions index, which actually has been easing on net since the October of last year. That's almost a year of net easing. So if financial conditions are easing, it's sort of hard to say that monetary policy is having a large negative impact on growth right this minute. We think it's diminishing, and we think the impact is going to continue to diminish, assuming that we're now either at the end of the rate hikes or almost at the end of the rate hikes. And we think we're actually at the end of the rate.
So you're not in are you in the camp where no more rate hikes at the next Fed meeting? They're done for this cycle.
Next Fed meeting in a couple of weeks, highly unlikely that they hike. I think that's already been pretty clearly signaled. Beyond that, I think it's possible that you get another hike, but it's not our expectation.
Would a part of that hike be a function of we're now seeing oil prices back to $90 a barrel? We're seeing food prices, as a result, pick back up in many places. How concerned are you about this disinflationary narrative becoming inflationary again next year?
Well, I think headline inflation, of course, depends to a significant degree on what happens to commodity prices. So increases in commodity prices will be visible in terms of headline inflation. The real concern, though, from the Fed's perspective, has been core inflation, underlying inflation getting entrenched in the economy. And I think there, the news flow has been very positive. It's been positive in terms of the core inflation indices. It's been positive in terms of the labor market rebalancing. It's been positive in terms of supply chain disruptions disappearing. So none of that is really being called into question by the commodity price rebound, although, of course, commodity prices matter for headline.
How tough will it be for the U.S. economy to withstand the restart of student loan payments? And where do you fall in that debate?
We do think that that's going to be, a modest drag on growth in the fourth quarter, or maybe in the first quarter. It's going to take a few tenths of the increase in real consumer spending. We do think that Q3, where we're estimating almost 3% quarter-on-quarter growth, and other estimates are even higher than that, that's probably going to be sort of a local high. Fourth quarter, we think, is going to be lower than that, maybe closer to 1% than to 2%. But I don't think it's going to be a long-lasting or deep slowdown. We think it's going to be, in the end, something that keeps us at a trend or slightly below trend pace. But in 2024, we expect a reacceleration to about 2%.
The other note you wrote that U.S. consumers will likely outperform in 2024. And I think that might be the contrarian view on the street, depending who you talk to. Why are you so confident in the consumer here? We have seen a lot of retailers, Macy's, you name it, warn about rising delinquencies and people not being able to pay their bills.
I mean, at a macro level, if there was only one indicator that I could know regarding the consumer, it would be real disposable household income. And that has been growing at a 4% pace in 2023. We think 2024 is going to be a little weaker, but we're still expecting about 3% real disposable household income growth. If that's right, or even if that's anywhere close to right, then it's very difficult to see declines in real consumer spending. And in fact, we're expecting continued moderate growth. Now, that's at the most macro level. Of course, you can drill down into the different income groups, the different types of households, the demographics. And I would agree that probably a bit more of that growth is going to be towards the top end of the income distribution. And the bottom end of the income distribution, I would expect to be somewhat softer. And I think that would be consistent also with some of the things that we've seen on delinquencies among lower income consumers. That said, we're still expecting income to grow for low-end consumers. We expect real wages to grow, and we don't think that there will be a large deterioration. But incrementally, it's probably going to be a little bit softer than in the macro numbers.
Within your outlook for next year, in terms of monthly job creation, are we still over 100,000 jobs created each month? And where do you see the unemployment rate going?
In the next year, we still think 100,000 or a little bit more than 100,000. There is a deceleration in job growth. Job growth is normalizing from the really outsized rates that we saw coming out of the pandemic. But yeah, we think it's going to be a gentle decline. Again, this is going to, of course, depend on how the overall economy does. What happens to GDP? If GDP grows, 2% or so next year, then I think you can be pretty confident that we'll also continue to create a decent number of jobs, 100,000, 125,000, 150,000. And I think there are good reasons, including the income point I just made, to expect that growth is still reasonable. In terms of unemployment rate, we're expecting more of the same, meaning about 3.5%. We're at 3.6% for the end of next year. We saw a 0.3 percentage point increase in the unemployment rate in August in Friday's employment report. However, that was entirely driven by an increase in labor supply, so it's not a concern. Normally, if you'd asked me if you saw a 0.3 percentage point increase in the unemployment rate, I might say it's a little concerning, but if you dig into the details and look at layoffs, still very low, but increases in the labor supply, that is something that is, I think, reassuring. So no real change. We've been in the sub 4% range for unemployment since early 2022, and we still expect to be there next year.
Jan Hatzius, Chief Economist at Goldman Sachs. Always great to get some time at this conference, and always a pleasure to read your team's research. Some of the best in the game.
Thank you so much. Wonderful to be here.
Back to you guys.
Closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. ARM Holdings submitting an update to its IPO filing, setting a price range for its Nasdaq debut. The chip design company looking to price its offering between $47 and $51 a share. That would value the company at nearly $52 billion a share, making it the largest IPO on Wall Street this year. Oil prices jumping to a 10-month high, the move coming after Saudi Arabia and Russia extended production cuts for at least another 3 months. That would be longer than analysts had expected. The cuts from Saudi Arabia will keep production at about 9 million barrels a day, which is at its lowest level in several years. Finally, Warner Brothers Discovery putting a price tag on the cost of the Hollywood strikes. The company expected earnings to take a hit between $300 to $500 million this year, but the company also made clear it can't predict when the strikes will end, but hopes it will be soon.
Time now for What to Watch Wednesday. First up, the Federal Reserve's Beige Book will be out 2 p.m. Eastern Time, giving investors insight into the state of the U.S. economy. We'll also hear from Boston Fed President Susan Collins. She's scheduled to deliver remarks at the New England Council. Meanwhile, on the earnings front, results from GameStop and C3 AI. GameStop's report is the first to follow the recent ouster of its CEO and the resignation of its CFO. The company did not hold an earnings call after its last earnings report. And C3 AI is set to report its fiscal first quarter results. The stock posting big gains since the start of the year thanks to the boom in AI, looking at gains at just about 180%. The pressure, though, is going to be on C3 AI. Investors want to know and will be looking for signs of future momentum. And also the stakes are high because NVIDIA exceeded Wall Street's expectations recently. And last but not least, make sure to tune into Yahoo Finance's coverage at Goldman Sachs Communacopia and Technology Conference. Brian Sazi is going to be speaking with top executives, including CEO of Paramount Global Bob Bakish and AT&T CEO John Stankey. You won't want to miss that. That does it for us today on Yahoo Finance Live. You got to be sure to come back tomorrow, 3 p.m. Eastern Time. We'll have all your coverage leading up to and after the closing bell. We'll see you then.